Today we're going to talk about mutual funds, one of the most popular ways to invest. I'm going to talk a little bit about them, how they operate, what they do, and then talk a little bit about a new kind of stepsister called the ETF, or Electronically Traded Fund. I hope this is informative and I hope you enjoy. I'm Jonathan Zimpelman, wealth advisor and owner of Axis Wealth Planning, an independent financial advisory firm based in Sumter, South Carolina. I believe that we've been tasked to be good stewards of God's assets, not accumulators of our own. So my goal is to try and educate and empower you so you can make good financial choices for your future. When I first sit down and meet with clients, one of the first things that I like to discuss is the way that we're going to invest their money. And typically, we invest in mutual funds. The reason why we do that is we want diversification. We want to spread our risk out. We don't want to have all your eggs in one basket. And a mutual fund gives you the perfect vessel to be able to do that. A mutual fund is exactly what it sounds like. It is where your money is pooled together mutually with others to be one investment. The advantage is you get more buying power when you have lots of people come together. This person puts in $200, this person puts in $200, you get 5 or 6 you get $1,000. You can spread the $1,000 out a lot further than your $200. Typically with a mutual fund, we have a professional money manager, someone who's making day-to-day decisions about how that fund is invested. The analogy that I like to use is that of a baseball team. I'm a big baseball fan, love the Chicago Cubs, so I'm going to use them here. You are the owner of the team. You have a vision of what you want to achieve, what you want your end goal to be, what's your risk tolerance, what's your time horizon, what is the rate of return that you're going to need on this investment that you're putting away for retirement or for a down payment on a house or whatever it is that your goal is. My job, and the reason you hire me, is to put your goal into action, to make it happen. So what I do is I go out and try and find the mutual fund company or the manager that will make those day-to-day decisions. They're the ones that put the team together. They make the decisions about who's going to be the starting pitcher. You don't want 9 starting pitchers, so you've got to have your role players. You got to have a starting pitcher, a catcher, first baseman, a left fielder. And that's what they do, is they put that team together. They also monitor over here on the sidelines and on the bench who it is that they want to put in whenever one of their other players starts to struggle, and they make those moves as they see fit. Now me, as the general manager, I monitor them, I watch them, I stay on top of what they're doing, and I report back to you as the owner as to what it is that we're trying to achieve. If I think that we need to make a change, then we make a change. And one drawback to professionally managed mutual funds, and this can be a big one, is they can be expensive. All of these layers cost. So I've seen some mutual funds that can be up to 3% a year in expenses. And they don't send you a bill for that. You don't pay it that way. It instead comes out in fractions of a penny every day. So you don't ever really see how expensive the mutual fund is. Instead, it comes out of your return. So if they should have done 10%, it's got a 3% expense, you only get 7% of your return. Or if it's supposed to be 9% and it's a 1% expense, you get 8%. So you need to be aware of it. You've got to look in the prospectus and the fund literature to find out what the expense is. Make sure that it's worth it. Back in the 1970s, a gentleman by the name of Jack Bogle came up with a unique idea at the time, and that was to, instead of have a professional money manager make the decisions about what's going on inside this fund, what if we just bought an index? I don't remember if he bought the Dow Jones Industrial Average 30 companies or if he bought the S&P 500, I'm not sure. Might have done both. But he just bought everything that was in the index inside of the fund. When money came in, he spread it equally amongst the fund as the Dow or the S&P would do. That brought the expenses way down because he didn't have the layers of management and decision making that had to happen. But some professional money managers and mutual fund managers will tell you there's a drawback to that too. Yes, it's less expensive, but if you buy, for instance, the Dow Jones Industrial Average, which is 30 companies, if you were to buy that whole thing, then you can buy the good ones and the bad ones. And they say, in their defense, it's sometimes true, that by having a professional money manager, they get to pick and choose the winners and the losers. This is a debate that's gone on in this industry for years. I'm not going to solve it here, but I just want you to understand the differences between an active, professionally managed fund versus an inactive, passive index fund. We've also seen with technology a new type of fund that operates very similar to a mutual fund called an electronically traded fund. It has some advantages over mutual funds. The biggest is one of the other drawbacks of a mutual fund is that it only prices at the end of the day. So after the markets have closed, they evaluate what's inside of the fund and they determine what the net asset value is for that day. And it's not known until usually 30 or 40 minutes after the market closes. If you were to buy that fund that day, you don't know what you're going to pay for it per share. You'll find out at the end of the day, usually around 4:30 Eastern. If you're going to sell some during the day, you don't know what you're going to get. It might be pennies higher, pennies lower, until it prices at the end of the day. With an ETF prices throughout the day. So you constantly know exactly what it is that you're buying. Historically, ETFs followed indexes. Now we are beginning to see, probably in the last 4 or 5 years, kind of a merger of the two where you're seeing some actively managed ETFs and you're seeing, as Jack Bogle did, passive mutual funds. So just because it says ETF does not mean that it's a passive index fund. Just because it's a mutual fund doesn't mean that it's professionally managed. I'm kind of starting to blur the lines a little bit, but that's what's out there. That's the way the industry is evolving. So you need to understand if you're investing in an active or passive fund, whether it's a mutual fund or an ETF. It seems that the industry is moving toward more passive ETFs. What I've kind of seen in my years doing this, in 19 years doing this, is whatever tends to be trendy today probably won't be quite as trendy tomorrow. We'll see. But my goal here is simply just to try and educate you so when somebody talks about mutual funds or ETFs, you now have a better understanding of exactly what they're talking about. I hope you found some value in this. If you did, please consider subscribing, and I'd love to share more of these. Hopefully we'll have a lot more videos coming out soon. Thanks.